Pankaj Tibrewal is with us. He's founder and CIO at IKIGAI Asset Managers. Pankaj, good to have you with us here. Good morning. Thanks for your time. Prashant this side. You know, it's as I was just reading out these names, these are return of the favorite, which is PSUs in a very big way. I remember we spoke, briefly over the last couple of days, and you were saying that maybe, start to look at some consumer type of consumer-facing names, right? On the more value side. Is that still your view, or do you think anything has changed at all over the last couple of days? I mean, you're someone who looks at fundamentals and valuations very, very closely. So I think your problem was not really the election result per se, but valuations to begin with. So let's start there, Pankaj.
Good morning, Prashant. I think the verdict had surprised everybody in the market, but it's business as usual because the mandate continuity would be there. What I've been saying is that when I look at the data points, let's look at 3 or 4 data points. The first data point is that the last 4 years, the rural spend has been flat at about 4 lakh crores. But when you look at the capex expenditure, it has moved from 3.4 lakh crore to be expected to be 11.1 lakh, which is almost a 3x jump in capex. The second data point is the private consumption expenditure has the slowest pace in the last 21 years. And don't forget that private consumption expenditure is about 56% of GDP. The third data point is that agri growth has been the slowest since 2015-16, when there were 2 consecutive years of drought. When you look at these 3 data points, and along with the fact that FMCG weight in the NSE 500 is at a 13-year low, and also the fact when you analyze the results on the election day, about 65 to 70 seats were lost by BJP, mostly on the rural belt. So our sense is that going forward into the next 12 to 18 months, a lot of resources could be diverted to spur consumption, because that's the weak data point which is there in front of all of us. And the message is loud and clear. So I think there could be some shift. I'm not saying that the capital expenditure would be stalled completely, but the 24% CAGR growth which we saw for the last 6-7 years probably can come down, and that probably may not bode well for a lot of names which are very highly priced. I think from a portfolio standpoint of view, I believe few things need to be done, because market will see readjustment as you move ahead. And what are those readjustments? One, I think it will be back to basics in investing. I think quality will be preferred over momentum investing. One should avoid the low free float stocks which are there in the market. One should not get carried away by only narratives, and also give precedence to quality and fundamentals. And over the last 2.5 years, we have seen a huge breadth being positive. I think the narrow down of the breadth could happen now, and it could be back to growth investing versus value investing, which we were seeing for the last couple of years. And I think if you don't readjust to the portfolio, it could be painful from the next 18 to 24 months perspective. But looks like some readjustment will go through as you move towards more policy making changes in the next 6 to 12 months.
Pankaj, hi. Good morning. Good to be speaking with you. The thing with these words, value and growth, is that I think in the last 12 months, the lines really started getting blurred. What were traditionally value stocks, right? I mean, they started behaving like growth stocks, trading at 70, 80 times P. And to be fair, in some cases, even earnings were coming in. So I think it was getting really confusing. But let's talk sectors, right? Because the market's narrative has shifted very quickly in the last 24 hours. On the result day, it was all about now there'll be populism. We need to be buying more rural-facing stocks. If you see the screen today, there seems to be hope that NDA 3.0 will stick to the capex agenda. Which one do you think it will be?
Surabhi, I completely agree that they will stick to capex, investment-led growth, but we have to see what stocks are pricing in. The stocks were pricing in a lot of growth, and I think we will be a little surprised that managements would find it difficult to keep up to the expectations of the market narratives in the near term. Also, I think the valuation and margin of safety is limited in a lot of those industrial capital stocks. Don't forget, 4-5 years back, When I was in Kotak, we were the first fund house to call for China plus one, manufacturing as a great theme. But I think at a price, I think most of these stocks look to be quite expensive, and the margin of safety is extremely low. We believe that when you look at the other parts of the market, I think markets are offering value there. One is pharma. I think pharma has kept surprising us on the earnings upside over the last 2-3 quarters. Private sector banks looks to be very well poised in terms of valuations. Uh, some of the consumer names on both urban and rural discretionary looks to be quite good. And overall, I think it will be market breadth which will narrow down. It will not be the same broad-based breadth which we have seen. And also, we track one ratio, which is high P to low P stocks on NSE 500. That ratio made a peak, which is high P stocks made a peak somewhere around 2021. And we saw the value trade of low P stocks played out extremely well. I think the big leg has played out. And from here on, we should see quality return back as a style from a portfolio perspective.
Pankaj, just a clarification. You said margin of safety is limited only in capital goods stocks or in any other part of capex slash manufacturing as well? Just wanted to get the sector right.
So a lot of PSU names on defense railways, the margin of safety is less. A lot of capital good names, the margin of safety is less. And hence, we believe that one needs to be prudent in terms of risk in the portfolio. I think risk has been underappreciated for the last 18 to 24 months. But if there will be uncertainty as you move ahead, because finally you have to accept it's a coalition government, there will be pulls and pressures across. And let's see how market takes it as you move ahead. I think the immediate focus will be on the government formation. And then over the next 45 days, the budget will be presented, and we will see how and what's the narrative in the budget going forward.
Hi, Pankaj. Good morning and good to see you. When you said that you all were on that China plus one theme, in your earlier avatar, and you got it spot on. I'm just looking at the near term. A few days ago, you joined in. You were talking about FMCG. Boom. Those stocks did quite well. So it's calls like this that that make you quite happy, I'm sure. But a couple of quick questions. On the Nifty itself, we made a high a few days ago of around 23,300, 23,400 roughly. Do you think the near-term peak is done for the Nifty? And also, since we're talking about the cabinet formation, now since you'll have a couple of allies, some part of the street is a little bit nervous. What if ministries like Defense, Railways go to some of these allies? Will it, change things? Will it, derail that entire growth, the entire measures that we've seen in the last 10 years or so?
So answering your second question first, Nigel, coalition government is not bad, except the last two terms, which is 2014 and 19. Since 1989, India has been used to coalition governments, and we have seen growth despite of that. And don't forget, the biggest reform year was 1991, when Congress was in minority, and we unleashed the major reforms which the country has never seen. So I'm not against coalition, but it will have its own pulls and pressures, which will show up in the decision-making over a period of time. But our sense is that when I look at the data points from a rural perspective and the spend which has not been there for the last 4 years, and the consumption has been slowest in the last 21 years, I believe that some part of the resources from the government side will be directed towards spurring consumption in the near term. And I think markets will adjust towards it. We believe that the earnings downgrade cycle in the entire consumption space is behind us. And probably from here on for the next 24 months, we should see an upgrade cycle starting to begin, or probably if not, earnings downgrade should stop. On the first question on markets, I am not a great market timer or a technical analyst, but let's look at the fundamentals. Nifty ended with 1,005 rupees of EPS last year, which is FY24. If I was to state street expectations, I think markets are pricing in 1120 to 1140 of earnings on a consensus basis for FY25 and about 1240 of earnings in FY26. When we look at that number, and look at the market, I think markets generally bottom out at about between 16 to 18 times 1 year forward. And that's the number you should work out to see where you need to be aggressive in the market, despite of all negative news at that point of time, when that earnings or the P multiples come in, which is 16 to 18 times 1 or 18 months forward earnings. And I think that's something which will give you a fundamental anchoring from a bottom-up perspective.
Okay, all right, Pankaj, always good hearing your thoughts. Thanks a lot for joining in, and we look forward to chatting up with you as this market moves on. Well.